Okay, to start off this video, I'm going to show you how I solve for the first problem in this problem set, which is this one. So first, let me read the problem to you. So in here, problem 1, the Coffee Republic sells 3 coffee products in a foreign market and a domestic market. An income statement for the first month of 2020 shows the following. We have sales, which is $1,300,000. Cost of goods sold, which is $1,010,000, which would give us the gross profit of $290,000, and we have a selling expenses of $105,000 and administrative expenses, which is $72,000, which a total of $177,000, and of course the net income, which is $113,000. So in here we are given a table which consists of the 3 products and their sales, their variable costs, and variable selling costs. For product A, we have sales under the domestic market, which is $400,000, and for foreign market it is $100,000. As for its variable cost, it says here that it is 60% of sales, of the total sales. And then for the variable selling costs, again it is a percentage of sales, which is a 3%. And then we have a product B, which has a $300,000 sales under the domestic market, and for foreign market it is $100,000 as well. And for its variable costs, the percentage of sales is $70, 70%, and for its variable selling cost it is unknown, so we have to compute that as well later. And for product C, we have $300,000 sales under the domestic market, and for foreign it is unknown, so we have to solve it also later in the problem. And then for its variable cost or variable production cost, the percentage of sales is 60%, and its variable selling cost is 1% of the sales or total sales. So we have an additional information here, which is product A is made in a single factory that incurs fixed cost, which is included in a cost of goods sold of $48,000 per month. And then for product B and C, which are made in a single factory and require the same machinery, the monthly fixed production costs at the factory are $142,000. And then here, fixed selling expenses are joined to the 3 products, but $36,000 is direct to the domestic market and $38,000 to the foreign market. And all administrative expenses are fixed, and about $25,000 is traceable to the foreign market and $35,000 to the domestic market. And then we have here the contribution margin ratio for the company as a whole is 35%. So we are required of the following. So first, let's dig in with the first requirement, which is assume that the Coffee Republic has a separate managers responsible for each market. Prepare performance reports for the domestic markets and foreign markets. In your report, break common fixed costs into cost of goods sold, selling expenses, and administrative expenses. So here we are given a format, so we have to follow that later. Okay. So let's try to solve that in Excel first. Okay, now for the second requirement. It says here, assume that the Coffee Republic has a separate managers responsible for each product. Prepare performance reports for the 3 products. In your report, break down common fixed costs into cost of goods sold, selling expenses, and administrative expenses. And again, we're given a format to be followed, which is this one. Okay, now let's try to solve this in Excel. Okay, now onto the third requirement, which is, let me annotate that for you. Management believed that if foreign market was dropped, sales in the domestic market could be increased by $200,000. The increase would be divided 40%, 40%, 20% among products A, products B, products C respectively. Determine whether the foreign market should be dropped. Show supporting computations. Okay, let's now solve that in Excel. Okay, now onto the last requirement, which is this one. Management also believes that a new product D could be introduced at the end of the current year. The product would replace product B and would increase fixed costs by $30,000 per month. Assume that the foreign market will not be dropped. Determine the minimum monthly contribution margin that product D would have to produce in order to make its introduction desirable. Okay, now let's solve that in Excel. Okay, now let's work on the first requirement, which is requirements number 1. Okay, so now let's try to solve the requirement number 1, which is making a segmented report, financial report, using the format that was given earlier. Okay, so first let me just put a format. This is for line A, line B, line C in the total. Let's merge this so that it's going to be under the domestic market. Let's just copy this one right here. Let's change this to foreign market, and we're going to also input the summary. Okay, so first let's start with the sales. And let's just input the data given. So under the domestic market, for line B, the sales is 400,000. For line B, it's 300,000. For line C, it is as well 300,000, and let's just sum it all up. There you go. It is 1 million. And now let's input the variable expenses. Under the variable expenses, we have the variable production cost, and then we have the variable selling cost. So for line A, the variable production cost is 60% of the sales. Okay, there we go. And for line B, it is 70% the sales, which is input point 70. And then for this one, for line C, it is as well 60% of sales. So this one multiplied by 0.6. Let's move that up. Let's get a total of it. And then we have a total of 63,000 variable costs under the domestic market. And then for the variable costs, we have a variable selling cost rather, going to multiply for the sales by the percentage given in the table, because it just said that percentage of sales. So for line A, it is 3% of 400. We're going to get 12,000. And then for line B, it is 1.05% of sales, which I'm going to show a clip here on how I got the 1.5%, because based on the given a while ago, it is unknown. So okay, so now I'm going to show you how I come up with the 1.5% of variable selling cost based on sales of the product B or line B for both domestic and foreign market. So what we're going to do here is that first, let's take this total sales. Total sales, which is 1,300,000. And then we're going to multiply the difference between 100% and the contribution margin ratio, which is 35%. So why? Because if we're just simply going to multiply the 35% to the total sales, we will get the contribution margin. However, we want to know how much is the total variable cost. So to get that, we have to deduct the 35% contribution margin ratio to 100%. The 100% represents sales. So we're going to multiply 1,300,000 by 100 minus 35%, which is 65%. This would give us 845,000 variable costs. So for contribution margin, of course, we're going to get 455,000. So now let's focus on this one. So total variable cost is 845. And we already computed for the total production cost, total variable prod cost or production cost, which is 820,000. So we're going to be left with the total variable selling cost, which is 25,000. However, we have already computed for the variable selling cost of line A for both domestic and foreign market, which is 15,000. And we have also computed for the variable selling cost of line C for both domestic and foreign market, which is 4,000. So we will be left with the variable selling cost of line B, which is 6,000. So for this, we're going to use algebra to solve for the percentage. So our equation would be 300,000 x plus 100 1000x is equals to 6000. So in here, let x be the percentage of the variable cost of line B to sales. You have to take note that the percentage for both domestic and foreign market should be the same. So let's find the value of x now. So it's going to be 300,000x plus 100,000x give us 6,000, and combine like terms. So 400,000x is equals to 6,000, and the value of x is 6,000 divided by 400,000, which would give us 0.015, or simply 1.5%. So that's how we solve for 1.5%. Yeah. And then for line C, it is, let's just check down, it's 1%. Oops. There. So we're going to have total of 19,500. And then after deducting the variable cost to the sales, we're going to get the contribution margin. Let's just sum the numbers all up. And there you go. So for line A, the contribution margin is 148,000. For line B, it is 85,500. And for line C, it is 117,000, and the total contribution margin for the under the domestic market is 350,500. So now let's proceed onto the common fixed cost. Common fixed costs, and we're going to divide the common fixed cost into two, which is first the traceable fixed costs. Okay, so under the traceable fixed costs, we're going to have, well, based on the problem, first is the selling expenses, because it is specified in the problem that, let me just go back to the problem. Fixed selling expenses are joined to the three products, but $36,000 is direct to the domestic market. That pertains that it is traceable to the domestic market. So we're just going to input that there. But here, I'm going to put this at the total. Why? Because there's no data given in the problem on how are we going to allocate the 36,000 to the three lines or the three products. So let's just assume that it is traceable to the whole domestic market. So we're going to place at 36,000 here, the total. Oops, is it in line? Okay, it's aligned. Okay, now we're going, another traceable fixed cost based on the given in the problem is administrative expenses, which is 35,000. So again, just like what we did in the selling expenses, we're going to place it under the total column, because in the problem there is no given data with regards to the allocation of the administrative expenses to the three lines or the three products. So after deducting that, we're going to get, of course, the segment margin. So in here, segment margin for line A is 148,000. For excuse me, for line B it is 85,500, and then for line C it is 117,000, and then for the total segment margin under the domestic market, it is 279,500. So we're going to double rule here. Okay, now let's proceed onto the, now we're going to have a total of segment margin of 279,500. Now let's proceed. Okay, let me delete this one first. So now let's proceed onto the segmented financial report under the foreign market. So for line A, the sales is 100,000, and then for line B, it is as well 100,000, and then the sales under line the sales for line C is not given, so we're going to have to work that back. So based on the income statement that was provided in the problem, the total sales for the coffee bean company is 1,300,000. And since we have already completed the segmented report under the domestic market, it is showed that the total sales in the domestic market is 1 million. Let's just deduct that from our total sales, and then we're left with the sales for the foreign market, which is 300,000. And again, given the problem that the sales for line A, line A is $100,000, so we're just going to deduct that from the total foreign market sales. And then we also have sales in line B, which is 100,000 as well. Oops. So we're left with the sales in line C to complete the 1,300,000 total sales, which is $100,000. So that is the total sales for line C. So the total sales for under the foreign market is $300,000. Now let's proceed into the variable production costs. Okay, let me go back to the problem. So the variable production costs for line A is 60% of the total sales, which is 60,000, and for line B it is 70% of sales. So our variable production cost for line B is 70%, and the variable production cost for line C is 60%. And then let's just get a total of those three. I'm going to get a total of 190,000. And now let's proceed onto the variable selling cost, which, given the problem under line A, it is 3% of sales. For line B, it is 1.5%, and for line C, it is 1%. Oops. and the total of it is $5,500. And then now let's compute for the contribution margin. So for line A under the foreign market, the contribution margin is $37,000. For line B, it is $28,500. For line C, it is $39,000. And for the total contribution margin under the foreign market, it is $104,500. Okay, now let's proceed into breaking down the common fixed cost. Okay, now let's input the traceable fixed cost for the foreign market. So given the problem, the traceable fixed cost or the selling expenses is $38,000. So let's just deduct that in the total column. And then as for the administrative expenses, it is $25,000. So if you're going to ask me why did I place it under the total column, it is because there is no data given in the problem on how to allocate this cost among the 3 product lines. So yeah, so we're going to get now the total segment margin. Oops. There you go. So for line A, it is $37,000. For line B, it is $28,500. For line C, it is $39,000. And for the total segment margin under the foreign market, it is $41,500. So let's just double rule here. Okay. Now let's proceed to the summary. So we're just going to copy total sales for domestic, which is $1 million. For foreign, it is $3,000. And then for the variable costs, a total of $630,000 for domestic and $198,000 variable production cost under the foreign market. And then total of $19,500 variable selling costs under the domestic market, and a total of $5,500 variable selling costs under the foreign market. Then going to get the contribution margin, which should be the same, the totals there, 350, 500 for domestic and 104,500 for foreign. So let's just get the total of these numbers. Just there you go. Okay, that's too much. Going to get these numbers, and it is just the same in the totals in the foreign and domestic market. Now here, traceable, we're just going to copy this one, 36,000 for selling expenses under the domestic, and then 35,000 for administrative expenses under the domestic market, and $38,000 selling expenses under the foreign market, and $25,000 administrative expenses for foreign market. And then let's just get the total of these numbers. So a total of 74,000 traceable fixed cost, well, specifically selling expenses, and a total of $60,000 for administrative expenses. Then we're going to get the total segment margin for the domestic and foreign market, and of course for the total company. There you go. See, again, under the domestic, the total segment margin is 279,500. For foreign, it is $41,500, and then for the whole coffee bean company, the segment margin is $321,000. Okay, let's double rule this one. Okay, let me just insert a couple of rows here. So now let's break down the non-traceable fixed cost. So the non-traceable fixed cost for coffee bean are as follows: the fixed production cost, the fixed selling expenses, and fixed administrative and then we're going to get the net operating income. Okay, so if you're going to ask me where did I get the fixed production cost, or why is there an account title which is fixed production cost even though it's not given in the problem, so let me explain that to you. So based on the income statement for the first month of 2020, we have cost of goods sold, which is $1,010,000. Okay, so as we all know, under the cost of goods sold, both variable and fixed production costs are present. So in here, just going to deduct the variable production costs. Production costs for both domestic and foreign, which is 630,000 and 190,000. So we'll be left with the fixed production costs, which is 190,000. So if we're going to break this fixed production costs further, it is the fixed production cost for product A, which is stated in the problem that is already included in the cost of goods sold, which is 48,000 per month. And then for product B and C, it is 142,000. So it's just the same. There you go. So we have already broken down the cost of goods sold. So this is the computation on how I got the 190 fixed production cost. So we're going to deduct the 190,000 here under the total column, because because this fixed production cost are not or is not traceable among the domestic and foreign market. So yeah, it's considered a common fixed cost. Now let's proceed on to the fixed selling expenses. So based again on the income statement that was provided, the selling expenses is 105,000. So let's break this $105,000 down. So under this one, or under this account title, we're going to deduct the variable selling cost. If you're going to ask me, why are we going to deduct this the variable selling cost under the selling expenses and not in the cost of goods sold? Well, it is a selling cost. It does not form part of the cost per unit of a product, so it's definitely under the selling expenses. So we're going to deduct that. Okay, let me break this down furthermore. So under the domestic and under the foreign market. So for domestic, it is 19,500, and for foreign market, it is 5,500. And then we're going to deduct as well the traceable fixed cost or traceable selling cost under the domestic and foreign market. Woo, calm down, dogs. Okay. For the domestic, it is 36,000, and for foreign, it is 38. So we're left with the common selling cost. So it is 6,000. So we're going to deduct that 6,000 under the total column. And now, and lastly, for the fixed administrative, so based on the income statement, the administrative expenses is 72,000. And it is also stated in the problem that 25,000 of it is traceable to the foreign market, and the 35,000 of it is traceable to the domestic market. So we'll be left with the common administrative expense, which is 12,000. So we're going to deduct that as well under the total column, and then now we could solve for the net operating income for the coffee bean company, which is what happened? Which is 113,000, and as you can see, it is the same with the income that was presented in the income statement. So yeah, we've finally broken down the items in the income statement, and all the balances in the income statement, the provided income statement rather, and the segmented income statement reconciled. So yeah, now we're done with the first requirement. Now let's proceed on to the requirement number 2. So it's just the same. We're going to make a segmented income based on the given format. So let me just input the headers. Domestic, foreign, total. This is for line A. I'm just going to copy this one, place it here. I'm going to change this to line B, and this one to line C. And summary. This is line A, line B, and line C. Total. Ooh, it's gonna take a lot of space. Let me just readjust this one. Okay. Oops. Okay, now let's proceed in inputting all of the data needed. So again, let's start off with the sales. So under line A, under the domestic market, it is 400,000. For foreign, it is 100,000. It would give us a total sales under line A of $500,000. For line B, under the domestic market is 300,000. For foreign, it is 100,000. Oops, too much zero. And total of $400,000 sales under line B. And then for line C, under the domestic market, it is 300. For foreign, it is 100,000. And total for line C, total sales for line C is $400,000. Next, let's input the variable expenses. For variable, under variable expenses, we have the variable production costs and variable selling costs. So under the domestic, it is 60% of sales. For foreign, well, the same, it is 60% of sales. Total of $300,000 variable production sales under the line A. And then for variable selling cost, it is 3%. And for foreign, it is 3% as well, which would give us a total variable selling cost of $15,000. Then we're going to get now the contribution margin. Margin for line A, which, there we go. Under the domestic, the domestic market, the contribution margin is 148,000. Under foreign market, it is 37,000, and the total contribution margin for the product A or line A is $185,000. And then now let's deduct the fixed cost. So let's start first with the traceable fixed cost. And for this report under the line A or product A, the only traceable fixed cost is the fixed production cost, which is the machinery that is included in the cost of goods sold, which is $48,000. Now we could compute for the segment margin of line A, which is $137,000. So I'm just gonna double rule that. Let's double rule this as well. Oh, what did I do? Oh my gosh. There. Sorry about that. Okay, now let's proceed on to the line B. Okay. So for line B, the variable production cost is 70% of the sales, as well as under the foreign market it is 70% of sales, which would give us a total of 280,000. And for the variable cost, it is 1.5% of sales. Get the sum of that is 6,000. And for the contribution margin, under the domestic it is 85,500. For foreign market it is 28,500, and the total contribution margin under line B is 114,000. And then there are no traceable fixed costs under line B. So it means that our contribution margin is already our segment margin. There you go. Now let's proceed onto line C. So for the variable production cost, it is 60% for both markets, 60% of sales. Okay, and then we get the total, which is 240,000. And for the variable selling cost, it is 1% of sales for both markets. And the total variable selling cost for line C is 4,000. Now we're going to compute for the contribution margin of both markets and the total. So contribution margin for domestic market under line C is 117,000. For foreign market it is 39,000, and then for the total contribution margin for line C it is 156,000. And then for the traceable, again there are no traceable fixed costs under this. So it means as well that our contribution margin is the segment margin for there. So now let's complete the summary report. It was 500 and this is 400. Line C, it is 400. I'm going to get 300, 240 and 40, total of 820, which is the same in the first one as well. And this one 15,000, 6,000 and 4,000, which would give us 25,000. And contribution margins, oops, and there you go. You can see it's just the same. $185, 114, 156. Now let's place this one, fixed production cost. We're going to have our segment margin, and let's just double rule for the 3 lines. Okay, now we're going to work on the fixed common fixed cost, or the non-traceable fixed cost. So under that we have the fixed production cost, the administrative costs, and the selling expenses. There should be expenses din pala. So for the fixed production cost, the computations should be, let me just put net operating income here. So for the for the computation of the fixed production costs, it should be based again on the cost of goods sold, which is $1,010,000, and then we have the variable production cost, which is this one. And then we're left with the fixed production cost, which is $190,000. However, 48,000 of it is traceable to line A. And we're left with $142,000. And then if you're going to ask me, isn't it stated in the problem that the 142 is for both products B and product C? Yes, it is. However, it is said in the problem that products B and product C are made in a single factory and require the same machinery. So there's no allocation provided in the problem on how are we going to allocate this 142 fixed cost to both product B and product C. So it's considered as a common. I'm just going to deduct it in the total. So this is 142. And then for the fixed for the administrative expenses, the total is, in the problem it is stated that $25,000 is for the foreign, and the and the 35,000 is for the domestic. However, we're going to place the whole 72,000 in the common fixed cost. Why? Because we are doing a segmented report based on the product lines, not on the two types of market, the foreign and domestic. So if we're going to look at this the perspective of having segmented income for the three lines, our administrative expenses become a common fixed cost, because you cannot trace it here, and there's no even allocation provided. And how are we going to allocate this this expenses among these three product lines and further allocate it accordingly in the markets? So we're just going to place it here. Now for the selling expenses. According to the problem, the selling expenses is 105. Okay. Selling expenses, total of 105. So let's deduct the variable selling cost, wrong spelling, which is 25,000, and the remaining is for common fixed cost, which is 80,000. So let's deduct that from the total segment margin, and then we're going to we'll be able to compute for the net operating income of Coffee Bean Company, which is 113,000 as well. So this is for the requirement number 2. Okay, so now let's proceed onto the third requirement 3, which is management believes that if foreign market was dropped, sales in the domestic department could be increased by $200,000. The increase would be divided 40%, 20% among products A, B, and C respectively. Determine whether the foreign market should be dropped. Show supporting computations. Okay, so for here, let me just put the heading, line A, line B, line C, and of course the total. This is for the domestic market. There you go. Since the foreign market would be dropped. So let's place. So I'm gonna put here the incremental increase in sales. So the incremental increase is $200,000, and we're just going to multiply the allocation of this increase, which is for line A it is 40%, for line B it is as well 40%, and then for line C it is 20%. There you go. So for line A, its incremental increase would be $80,000. For line B, the incremental increase would be $80,000, and for line C, it is $40,000. And then, since our sales increased, our variable cost should also increase. So we're going to input here the incremental increase in variable cost production. Okay, let me adjust that for a while. And of course, the incremental increase in variable selling costs. So we're just going to follow the percentage of the variable production cost to sales, which is for product A, that is 60%. So let's just multiply the sales by 60%. And for product B or line B, it is 70% of the sales. And then for line C, it is as well 60%. Give us a total of $128,000 increase in the variable production costs. Now for the selling costs. So again, it is 3% of the sales. And for line B, it is 1.5%. Oops. For line C, it is 1%. And then it would give us total of 4,000 incremental increase for variable selling costs. And of course, if we're going to deduct the increase in the variable costs from the incremental increase in sales, would get the incremental increase in contribution margin. Again, let me adjust that for a while. Then let's get the sum of all of these numbers. So for line A, its incremental increase in contribution margin is 29,600. For line B, it is 22,800. For line C, it is 15,600. And of course, we'd get the total incremental increase in CM, which is 68,000. So since foreign market would be dropped, there's going to be, of course, loss on sales for foreign market, which is 300,000, which is the total sales of the in the foreign market. And then of course, since the foreign market would be dropped, so its cost will be considered as savings because we don't have to incur them anymore. So let's input here the savings in foreign market. So under these, of course, we have the variable production cost. Wrong spelling. Okay. Production cost, variable selling costs, or expenses rather. And then we have the fixed selling expenses, fixed administration expenses, this should be negative since it is lost. And for savings, of course, we're going to save 190,000 variable production cost and going to save 5,500 variable selling cost. And for fixed selling, of course, we're going to save 38,000, and for the administration cost, we're going to savings of 35,000. So if we're going to sorry okay, so if we're going to get the sum of these numbers, we're going to have negative 41,500, which is lost income from foreign market. Now we know how much is our loss from closing the foreign market. Now we've already computed how much is our loss in closing the foreign market. So now we could identify if it's better off to drop the foreign market. So to compute for that, we're going to get the incremental increase in contribution margin and then we're going to deduct the lost income from foreign market. This is 68,000 less, of course, of 41,400, and the sum would be 26,500, which would be the incremental segment margin. So there you go. So answering the question, should the foreign market be dropped? The answer is yes. It is okay to drop the foreign market, because even though we've lost 41,500 income from the foreign market, at least we still have an incremental increase in the segment margin, which is 26,500. Okay, now let's proceed onto the requirement number 4. So to compute for this, all we have to do is to get the contribution margin of the product to be replaced, which is product B, domestic. Why domestic only? Because it is stated here in the problem, assume that the foreign market will not be dropped. So it means that the product B in the foreign market is not going to be dropped. So the only product that will be dropped by the management is the product B in the domestic market. Okay, so after that, you're going to add the additional fixed costs for product B, and then we're going to get the minimum monthly contribution margin. So let's put the numbers for the contribution margin of product B domestic, that, well, referring to the previous solutions, it is 85,500, and the additional cost stated in the problem, it is 30,000. So our minimum monthly contribution margin is 15,500. So why is the computation like this? So it is asked in the problem that we have to determine the minimum monthly contribution margin that the product B would have to produce in order to make this introduction desirable. So it means that the contribution margin of product B must be higher than the contribution margin of the product that will be dropped, which is product B. And also we have to add the additional fixed cost of product B, so that we could establish the required minimum monthly contribution margin to be achieved by the new product, and that is 15,500. But if you also want to know how much is its contribution ratio, all you have to do is, all we have to do is to divide sales of both foreign and domestic. Of product B, and that is 400,000. So the contribution margin ratio is this one. There you go. 28.875%. That is a contribution margin. But if you want to know the dollar amount, that is 15,500. So that's all for the problem 1.
So in this problem, we are given the following data about the coffee division of Bag of Beans Company. We are given the selling price of $40, variable cost per unit of $24, fixed cost of $200,000, investment of $1,120,000, and a budgeted sales of 30,000 units. Our first requirement is to compute the planned ROI to be expanded into margin and turnover. To calculate the division's return on investment, we will divide its net operating income by the total cost of investment. To calculate the net operating income, we must first calculate the sales. And from the sales, we will deduct the variable cost, arriving at the contribution margin. And from the contribution margin, we shall deduct the fixed costs, which should give us our net operating income. To calculate the sales, we will multiply the selling price of $40 by the budgeted sales in units of 30,000. And to calculate the variable cost, we will multiply the variable cost per unit of $24 by the budgeted sales in units of 30,000. And we will deduct the resulting amount, the variable cost, from the sales to arrive at the contribution margin. From the contribution margin, we shall deduct our total fixed cost of 200,000. To calculate the ROI, we will divide the net operating income of 280,000 by the total cost of investment of 1,120,000. We will get an ROI of 25%. To compute for the margin, we will divide our net operating income by the total sales. So it is the net operating income of 280,000 to be divided by the total sales of 1,200,000, which should give us 23.33%. For the turnover, our formula is to divide the sales by the total investment. As a shortcut, we can just divide the return on investment by our margin, since margin times turnover is equal to return on investment. Following that formula, 25% divided by 23.33% would give us 1.07, which is our turnover. As a follow-up in the situation given earlier, the division manager is given investment opportunities A, B, C, D, and E with different annual profits and investment costs. We are asked to determine which investment opportunity will give him the highest ROI and to calculate the new ROI for his division. To determine which is the best investment opportunity, we must first calculate the ROI considering the current balances of the annual profit and the investment cost of the division. As computed earlier, our annual profit is 280,000, and for our investment is 1,120,000. To calculate the ROI, we will combine the two figures, the one referring to the individual investments and the one referring to the division itself. As mentioned earlier, to calculate for the ROI, we must divide the annual profit by the total investment. Looking at the ROI, the best investment opportunity in this situation is letter D. Choosing letter D would result to an ROI of 27%. In this problem, we are presented with the same figures as the last one, only this time, the manager wants to maximize his residual income, and we must determine which project will give him the highest possible residual income at the minimum rate of return of 20%. To start solving this problem, we must first compute for the minimum return for each investment. The minimum return can be calculated by multiplying the minimum rate of return of 20% by the amount of investment in that project for the current project of the division. The investment is 1,120,000, which is to be multiplied by the minimum return, and we will get 224,000. For A, it is the investment of 225,000 multiplied by the minimum rate of return, and we shall repeat the same procedure in the figures referring to the other investments. To get the residual income, we will deduct the minimum return from the annual profit. That is minimum return to be deducted from our annual profit. For the current investment, it is 56,000. And for the investment A, it is 27,000. For investment B, negative 5,000, negative residual income. For the investment C, there is no residual income. For investment D, 30,000 residual income. And for investment E, it's 15,000. All the investments with less than 0 residual income or equal to 0 will be rejected. In this case, the only investment opportunities which we will choose are investments A, D, and E. Once we approve investments A, D, and E, we will have a residual income totaling to 128,000. In this problem, we are asked to compute for the total sales volume, the total dollar sales, and the additional investment that the coffee division has to make to achieve an ROI of 30% while maintaining its investment turnover. The best way to start in solving this problem is to find the formula in solving the additional sales in US dollars. So we are going to represent the additional sales in US dollars by X. And the formula for sales margin is net operating income over sales. Sales is equal to current sales plus the additional sales in US dollars. Net operating income, on the other hand, is the current net income plus the contribution margin multiplied to the additional sales in US dollars. We are going to substitute the last two formulas in our formula for the sales margin, and we will get the sales margin is equal to current net income plus contribution margin over current sales plus the additional sales in US dollars. We're going to multiply both sides by the current sales plus the additional sales in US dollars, which is sales margin multiplied to current sales plus additional sales is equal to current income plus contribution margin multiplied to the additional sales in US dollars. For distributive property, we have sales margin times current sales plus sales margin times additional sales in US dollars is equal to current net income plus contribution margin multiplied to the additional sales in US dollars. We are going to isolate all the terms which has X in it, and we have sales margin multiplied to current sales minus current income is equal to contribution margin multiplied to the additional sales in US dollars minus sales margin multiplied to the additional sales. Then we are going to factor the right side of the equation, and that is the sales contribution margin multiplied to X minus sales margin multiplied to X can be factored into X multiplied to the difference between the contribution margin and the sales margin. We're going to divide both sides by the difference between the contribution margin and the sales margin, and we will get that the value of X is equal to sales margin multiplied to the current sales minus current income all over contribution margin minus sales margin. Based on the given data, our turnover will be the same. To compute for the sales margin, we're just going to divide the ROI by the turnover. We will use the formula that we made for the additional sales, which is the sales margin multiplied to the current sales minus the current income all over the difference between the contribution margin, and the sales margin. And we will get sales amounting to 466,667 for the budgeted sales in units. We're just going to divide that by the selling price by multiplying the variable cost per unit to the additional sales. We will get the total variable cost, and by deducting the total variable cost from the additional sales, we will get the additional contribution margin of 406,667. To get the total sales, we're just going to add the current sales to the additional sales, and just like what we did, we'll also add the figures from the current operations of the company to the additional income that we will get by increasing the investment. We will get a net income of 466,667. The total budgeted sales, we're just going to add 30,000 to the additional sales of 11,667. And to get the total investment, we are just going to divide the net operating income by the return on investment And to get the additional investment that should be made, we're just going to deduct from the total investment the current amount of investment. And we will get that the additional investment that has to be made is 435,556. The additional investment will result to the budgeted sales in units of 11,667, which is $466,667. In this scenario, the division manager wishes to maximize his residual income. A new customer offers to the division manager to buy 10,000 units, $32 each, which is $8 cheaper than our usual selling price. If we are to accept the order, we will incur additional fixed cost of $10,000, and we will have to invest an additional $160,000 of various assets. We are to compute if accepting the order will increase our residual income. To properly evaluate the offer, we have to compute for the residual income. We will start by computing for the sales, which is the price per unit of 32 multiplied by the number of units, that is 10,000. Then we are to deduct from sales the variable cost, which is $24 per unit for 10,000 units. By deducting the variable cost from the sales, we'll get a contribution margin of 80,000. From the contribution margin, we're going to deduct the fixed cost, the additional fixed cost is 10,000. Then by deducting the fixed cost from the contribution margin, we'll get the increase in net income. The increase in net income is equal to 80,000 minus 10,000, which is 70,000. And from the increase in net income, we're going to deduct the minimum return. To compute for the minimum return, we have to multiply the minimum ROI of 20% by the investment of 160,000. So the increase in the residual income which is attributable to the offer, is equal to 70,000 minus the minimum return of 32,000, which is 38,000. Based on our computation, we will accept the offer since it will increase our residual income by $38,000. As a follow-up in the situation earlier, we have a maximum capacity of 35,000 units, and we are asked to compute for the number of the units corresponding to the regular sales that we are willing to sacrifice to accommodate the order of 10,000 units. To properly evaluate whether we must accept the offer or not, we must first calculate the residual income that we have from the regular sales. To do that, let us multiply the price per unit of 40 with the number of units, 30,000. For the variable cost, that is variable cost per unit, multiplied by 30,000 units. Then the difference between the two is our contribution margin. Our fixed cost is already given. Our net operating income is the difference between our fixed cost and the contribution margin. From our net operating income, we're going to deduct the minimum return, which is 20% of the investment on our regular sales. We have a residual income of 56,000. According to the problem, we must maintain this. So even if we accept, we must still have a residual income of 56,000. From this figure, we will work back. For the minimum return, that is 20% of the total investment. The original investment is 1,120,000 and the additional is 160,000. The total is 1,280,000. Then we will add the minimum return and the residual income to get the net operating income. And from the target net operating income, we're going to add our total fixed cost, which is 210,000, as a sum of 210,000, and the contribution margin can be calculated by adding the net income to the fixed cost, and we have a contribution margin of 522,000. To solve for the units sold for each respective price, we are to assign X as the unit sold at $40, Y as the unit sold at $32. Then the formula for the contribution margin is the contribution margin is equal to contribution margin per unit for the unit sold at $40 multiplied by the unit sold at $40. That's the contribution margin of the unit sold at $32 multiplied by the unit sold at $32. And our formula for our maximum capacity is equal to X plus Y. And if we isolate X by deducting Y from both sides, we will get the X is equal to maximum capacity minus Y. We're going to substitute the left side of that equation to the X term in the contribution margin formula. And we will get contribution margin is equal to contribution margin per unit at units sold at $40 multiplied by the maximum capacity minus Y plus the contribution margin per unit of units sold at $32 multiplied by the units sold at $32. By distributive property, the contribution margin per unit is equal to contribution margin per unit multiplied by the maximum capacity minus the contribution margin per unit at $40 multiplied by the units sold at $32 plus the contribution margin for the units sold at $32. Then we're going to isolate those terms with Y, or the units sold at $32. And we're going to divide both sides by the factors of Y on the right side. And we will get that Y is equal to contribution margin minus contribution margin per unit at $40 multiplied by the maximum capacity all over contribution margin per unit for units sold at $32 minus the contribution margin per unit of units sold at $40. To calculate the number of units to be sold at the price of $32, we're going to use the formula we computed earlier, that is contribution margin of 522,000 minus the contribution margin per unit of the units sold at $24 multiplied to the maximum capacity, which is 35,000, all over the difference between the contribution margin per unit of the units sold at $32 and the units contribution margin per unit of the units sold at $40. We were able to solve that the units to be sold at the price of $32, 4,750. To check, we are going to compute for the contribution margin using the figures for units sold that we computed earlier. So for the sales of for the regular sales, we're going to multiply the units sold at $40 by its price. And for the sales for the order, it is 4,750 units multiplied by the selling price of $32. Then we're going to multiply again the figures corresponding to the units sold to the variable cost per unit. We're going to deduct the variable cost from the sales to arrive at the contribution margin. We're going to sum up the figures to check. As you can see, we are correct. The contribution margin from these units is equal to 522,000, which is the required contribution margin to have a residual income of 56,000. As for the order, we are going to reject the order because we cannot accommodate the required units, which is 10,000 units, and also if we accommodate the maximum units that we can, which is 4,750 units, instead of sacrificing units of regular sale, we have to add 250 units of regular sale just to compensate with the residual income lost in accommodating the 4,750 units that is sold at a price of $32. In this problem, the division manager wants to maximize residual income. In the process of making their product, the division makes a special ingredient at a variable cost of $4. And also a supplier has offered to supply 30,000 units at a cost of $5 per unit. If the offer will be accepted, the fixed cost will decline by $20,000 and the investment will drop by $40,000. Considering the minimum required ROI of 20%, we must make the decision whether to make or buy the special ingredient. To properly assess whether we should accept the offer or not, we must first measure how much is its effect on our residual income. To start, we must adjust our net operating income to the changes in our cost. For our variable cost, we will incur more since we were used to incurring $4 per unit, and we are being offered $5 per unit. And at a level of 30,000 units produced in a year, will we have an increased variable cost of 30,000. And for the fixed cost, it is already given in the problem that we will have savings of $20,000. And for the net operating income, it was computed earlier that we will have $280,000. By adjusting the net operating income to these changes, we will arrive at the net operating income in case we accept the offer. The net operating income in case we accept the offer is equal to 270,000. From that 270,000, we are to deduct the minimum return, which is computed by multiplying 20% by the level of investment adjusted by the decrease due to accepting the offer. So that is 1,120,000 minus 40,000 multiplied by 20%. That is 216,000. By deducting the minimum return from the net operating income in case we accept, we'll get the residual income in case we accept. The resulting figure is 54,000. To compute the residual income in case we will not accept, we'll just use the net operating income we computed earlier, which is 280,000, and deduct from it the minimum return required at the investment level of 1,120,000. That is 1,120,000 multiplied by 20%. If we, after deducting the minimum return from the net operating income, we will get the residual income in case we reject. The residual income in case we reject is 56,000. So in conclusion, we must not accept the offer. Because accepting the offer will decrease our residual income by $2,000. In this problem, the division manager wants to maximize his residual income. He is considering to release a new product, which is to be sold at $20 per unit, with variable cost of $12 per unit. The product will increase the fixed cost of the division by $80,000. 15,000 units of the product are expected to be sold. We are required to compute for the maximum additional investment without reducing the residual income, considering the minimum required return of 20%. To get the maximum investment to be allocated to this project, we must first compute for its net operating income. To compute for the net operating income, we will compute for the sales, and from the sales we will deduct the variable cost. to arrive at the contribution margin. And from the contribution margin, we will deduct the fixed costs. And by deducting the fixed cost, we will arrive at the net operating income that is attributable to this new project. To calculate for the sales, we have to multiply the selling price by the budgeted demand for the new product, which is 15,000. We will multiply the variable cost per unit by the budgeted demand to get the total variable cost. By deducting the total variable cost from the total sales, we will get the contribution margin. We will then deduct the attributable fixed cost of 80,000 from the contribution margin to arrive at the net operating income. The net operating income attributable to this new project is $40,000. By dividing this net operating income by the minimum rate of return, which is 20%, we will get the maximum investment, amounting to $200,000. In addition to the previous scenario, we are to assume that the investment in the new product is $400,000, and introducing the new product will increase the sales of the existing product. We are to compute for the increase in unit sales of the existing product that will justify introducing the new product. To compute for the increase in unit sales that will justify the investment of the additional investment of $400,000, we must first calculate the residual income that is attributable to the additional investment. To calculate the increase in unit sales that will justify the additional investment of $400,000, we must first compute for the residual income that is attributable to the new investment. As computed earlier, net operating income attributable to the said investment is equal to $40,000. From that $40,000, we will deduct the minimum return, which is calculated by multiplying 20% to the additional investment of $400,000, which will result in a minimum return of $80,000. By deducting the minimum return from the net operating income, we will get the residual income, which amounts to negative $40,000. In this case, the increase in sales that is attributable to the introduction of the new product should be equal to $40,000. To calculate for the required increase in unit sales of the existing product that will justify the introduction of the new product, we will divide the increase in sales by the selling price. The selling price of the existing product is given at $20 per unit. By dividing the increase in sales by the selling price, we will get the required increase in unit sales. In this case, the required increase in unit sales is 2,000 units. The 2,000 units increase in unit sales of the existing product will justify the negative residual income of $40,000 and additional investment of 400,000.
As I observed this problem, I noticed that the service cost was allocated through the actual cost incurred. As per the guidelines in allocating service cost, it is necessary to allocate variable cost using predetermined rate applied to the actual services consumed. And for the fixed cost, what should be allocated is the budgeted fixed cost. In this problem, the first thing we need to do is to identify the variable and fixed component of the total actual cost of each month. In order to do this, we need to use a method we learned in our cost accounting and management accounting part 1 subjects, the high-low method. Step 1, we get the difference of the highest and lowest cost and cost driver. Then we divide 3,000 by 50,000 should we get the actual variable cost per unit. We consider the 20% excess of the actual from budgeted variable cost per unit by dividing 0.06 by 120% to get the budgeted variable cost per unit, which is the proper basis for allocating variable cost. Step 2, we try to get the fixed cost through getting the difference of the total actual cost of any month less the actual variable cost to get the actual fixed cost. Then we consider the unfavorable budget variance of 20,000 to get the budgeted fixed cost. Take note that whatever month we compute from, we will still arrive at the same amount of budgeted fixed cost, which is 150,000. For step 3 and the last, we just allocate the computer cost using the given lines of print for variable cost and percentage of computer's peak period capacity for fixed cost for the month of May and June, so we get the proper allocation of the service department cost. Finally, this ends our problem. We just computed for the appropriate allocation of the service cost in accordance with the guidelines for service department charges.